What is cash-on-cash return in commercial real estate? Have you ever wondered how investors measure the profitability of their cash investments in commercial real estate? One key metric they use is called cash-on-cash return. This financial tool helps investors understand how much annual income they earn based on the actual cash they have put into a property. To break it down, cash-on-cash return is expressed as a percentage. It focuses on the cash flow generated by a property relative to the cash equity invested. The formula is quite simple. You divide the property's annual pre-tax cash flow by the total cash invested and then multiply by 100. This gives you a clear picture of your return on investment. Now, what does annual pre-tax cash flow mean? It is the net operating income, which is the gross income from the property minus operating expenses. If there is financing involved, you also subtract any loan payments. This metric is different from total return on investment because it isolates cash income and excludes non-cash items like depreciation. Cash-on-cash return is especially useful for investors who use financing. When an investor finances a property, they often put down a smaller cash amount. This can lead to a higher cash-on-cash return compared to an all-cash purchase, assuming the property generates positive cash flow. For example, if an investor puts down $50,000 on a property and earns $10,000 in annual cash flow, the cash-on-cash return would be 20%. This means that for every dollar invested, the investor earns 20 cents back each year. This metric helps investors assess how effectively their cash is generating income annually. It is a straightforward way to evaluate and compare the profitability of different commercial real estate investments. Cash-on-cash return complements other analyses like capitalization rate and internal rate of return, giving a fuller picture of investment performance. In commercial real estate investing, understanding cash-on-cash return is essential for making informed decisions. It provides clarity on cash flow performance relative to the investor's equity contribution. So, when considering an investment property, remember to calculate the cash-on-cash return to gauge its potential profitability.